The Glenn Show, Rajiv. This is Glenn Loury at bloggingheads.tv and Brown University. And I'm with Rajiv Sethi, an economist whom I'm going to ask to introduce himself for the purpose of discussing Thomas Piketty's book, this widely revered and widely reviled Capital in the 21st Century. Rajiv, would you introduce yourself?
Sure, Glenn. Thanks for inviting me on your show. It's a pleasure to be here for the first time. I'm Rajiv Sethi. I teach economics at Barnard College, Columbia University, and I'm also on the external faculty of the Santa Fe Institute in New Mexico.
A fine institution it is, too, the Santa Fe Institute. I've had the pleasure of visiting with you out there.
Yes, it's a wonderful place.
Yeah, it is. Okay, so just to get us started, you are, in addition to being an economics professor at Barnard College, Columbia, a blogger, a widely read and broadly interested economist who writes about all manners of economics. And I'm just very interested to get your take on the book. So many reviews have been written, so much has been said, as I say, both revering and reviling. And I'm curious to know how you have received the book in general terms, and then maybe we can get into discussing some of the specifics.
Sure. I think that most of the reviews have focused on, understandably focused on what Piketty puts forward as the main message of the book, which is really a prediction about what's going to happen to global wealth inequality over the next century or so, and his prescription regarding what to do about it, and his basic sort of interpretation of the forces that generate wealth inequality, and this famous equation R bigger than G that he lays out at the beginning of his book. And there's been so much discussion of that, both on the empirical and on the theoretical front, that a lot of very, very valuable insights in the book have been missed in this reaction. And so that's what I focused on. You mentioned my blog, so I put up a brief review of the book on my blog. And I tried to focus on what I call the subplots in the book, which are very, very valuable insights. Piketty has immersed himself for a decade and a half in this immense amount of data drawn from a variety of sources. And, even if his intention was to describe what's happening to the future of wealth inequality, a huge number of insights on a variety of issues of interest to economists emerge along the way. And so I tried to focus on some of those.
Okay. I'd really like to get you to talk in more detail about some of those subplots in the book. I thought, though, that it might be helpful, even though everyone has probably heard this before, if we just reviewed what the main argument is, and correct me if I'm wrong, I'll try to summarize very quickly. The reason that the equation R greater than G is important, what it means is that the rate of return on capital exceeds the growth rate of the economy. This is an observation that he's making based on empirical data and a prediction that he's making about the trends likely to prevail over the course of the 21st century, is that because the return on capital is larger on this hypothesis than the growth rate of the economy, the relative holdings of people who are the owners of wealth, the share of the economy that they're going to control, will be tending to increase over time. And inequality in the holdings of the resources of the economy will continue to grow. Is that, would you concur with that as a description of the main argument of the book?
Yes, I think that's about right. So I think he argues that there was a peak in global wealth inequality around 1910, and after that, owing to two world wars, the Great Depression, and a complete change in attitudes towards taxation, there was an enormous decline, a structural transformation, if you like. But there was a period of rapid growth in population as well as growth in per capita output worldwide, which he believes is now coming to an end. Both the demographic growth and the per capita GDP growth is stabilizing because there's catch up. He thinks that economic growth at the technological frontier has never been particularly rapid, not more than about 1.5% a year per capita, and you get dramatically high rates of growth for countries that are that are catching up. So we are approaching the end of this catch-up period. And we're approaching, the end of the demographic transition worldwide. And so he believes that growth will stabilize, that the returns to capital will not decline substantially. And so we're going to end up in this situation where owners of capital will have an increasing share of total income until such a point is reached with a very high ratio of capital to total income and sufficiently high expenditure out of capital income. And at that point, things will reach some sort of steady state. But that steady state will have a great deal more wealth inequality than we currently have. That's his thesis.
So the 20th century, at least the first 2/3 of it, is an aberration relative to the underlying trend. And the extraordinary events of World Wars I and II, or perhaps we want to call that just one protracted conflict,
yes,
and the destructive force of that, along with the advent of the big welfare states, the sort of onset of social provision and social solidarity state throughout Northern Europe, to a lesser extent in the UK and North America, these aberrant one-time only historical phenomena and the one-time only, as you say, catch-up, merging into a globally prosperous economy of the developing regions of the world,
yes,
will have played out. And in the 21st century, therefore, the underlying force of greater and greater control of the means of production, as it were, by the wealthy, will reassert itself.
Yes, that's his claim. Unless, of course, there's some vigorous policy interventions, and he makes some proposals along these lines. But he believes that Kuznets, who's really a pioneer in looking at wealth inequality and sifting through the statistics in creative ways, was writing at a very unusual time. He was writing at a time of declining global wealth inequality, and was misled by the specialness of the period into thinking that there was a law that gave you declining inequality as economies tended to develop. So that's really his point of departure, and he disputes that reading of history.
Again, just so that people understand, this is Simon Kuznets,
yes,
and this is the famous inverted U law about how one expects inequality to behave over the course of the development of a country, initially rising to a peak but then declining thereafter.
Exactly, and so he believes that that this Kuznets curve was the result of these aberrations, as you put it, the wars, the Great Depression, changing attitudes towards taxation because of the rise in government debt to finance the wars, and that we are now returning to what Piketty considers to be a more normal evolution of capitalist societies.
Okay, now I can think of some of the objections that people have raised. Again, we're just in the first phase of our conversation here, in which we're sketching the main argument of this widely reviled and widely revered important book in economics.
Yes.
And we're going to go on to explore the subplots of this massive piece of intellectual work, which ambles all over the place in terms of observations it has to make about development economics and public finance and economic growth and all the rest. But we really want to just establish the baseline. So there's his argument in a nutshell. What are, in your view, the principal objections that have arisen to this core argument?
Well, an objection that I would raise myself, frankly, would be that projecting productivity growth and demographic change over the next century is a highly speculative exercise. It's in some respects a fool's errand. I mean, it's very, very. So he takes, for example, UN projections of population growth and historical information on productivity growth, and projects these forward in a way that's it's suggestive, but it's not terribly compelling to me, at least. And I find really, so if one were to break down the book into sort of its four central contributions, I would say that these are description, interpretation, prediction, and prescription. And the historical description is incredibly rich, detailed, it's a huge contribution, putting all this material together in one place. The interpretation of what has driven these historical trends is also interesting. But then the prediction and the prescription, the prediction about what's going to happen and the prescription about the global tax on capital, I find much less compelling. And now that doesn't mean that it's not valuable. It's just that I think that the more valuable parts of the book are in the historical description and the interpretation of history. So that's where I think really the value is. So one could criticize the emphasis, if you like, both by Piketty in the book and by others on the prescription and the prediction. But having said that, there are also very detailed objections. So there was the Financial Times objection, which argued that his empirical claims were wrong, that they did not hold water, and he has a very detailed response to this on his website. And he's especially concerned about the fact that the FT basically conflated survey data with tax data, and suggested trends by combining these two in ways that are just not very meaningful, especially because survey data underreports wealth, is well known to underreport magnitude of wealth relative to tax data. And I mean, I'm not an expert on these issues by any means, so I can't adjudicate this debate, but it seems to me that the consensus is that Piketty's response to the FT is very compelling and really, dispenses with those objections point by point in a very effective way.
Again, I should explain, Rajiv, excuse me for interrupting. I just want to explain for the sake of anyone out there who doesn't know. The Financial Times published a long and detailed critical assessment of capital in the 21st century, in which the writer claimed to have found a number of mistakes that Piketty made in the compilation of his data.
Yes.
And there has then subsequently been much discussion of this critique. Paul Krugman had a column, for example, in the New York Times critiquing the critique.
Yes.
And Piketty, as you just now have reported, has posted on his website a detailed point-by-point response to the critique, which I gather you find to be on the whole persuasive.
Yes, not just me, but I think a number of other people. So I think there was a recent posting by Diebold where he said that he was very supportive of the book, and then based on the FT critique, was enraged at the possible deception there, and then has completely come around to thinking that no, he was right in the first place, that the book, at least the empirical claims in the book, are solid. Now, I'm not the right person to adjudicate this, but I think that criticism has been dealt with quite adequately. On the other hand, there are theoretical critiques. There are various people. Per Crussell, for example, I think in a co-authored, Crussell and Smith have a critique that builds on points that were made by others, including Larry Summers. There's a critique by Devraj Ray. There's a very, very thoughtful, detailed piece by Matt Ronley, I think, and a graduate student at MIT, which are theoretically inclined. So they argue that he's not taking proper account of depreciation, that there's a confusion between net and gross returns, or the substitutability between capital and labor, that he's advocating doesn't make sense with the net measures that he's adopting. And also, one of the claims that Piketty made was that the ratio of capital to income. So he likes to measure capital in years of national income, and he is pointing out that both the capital income ratio and the share of capital income in both the ratio of aggregate capital to national income and the share of capital income in total income have been rising, and he claims that this is consistent with his theory and can be understood with his R bigger than G perspective. And Matt Rongley in particular has criticized this because if you have for example, an asset price bubble, you're going to have an increase in the value of capital, and those capital gains will show up as an increase in the rate of return to capital. And it's a spurious correlation. It's not causally connected in the way that Piketty claims it is. So I don't want to go too deep in the woods, but these theoretical points need to be addressed and answered. As far as I know, have not been fully addressed. But I think that they focus on a particular interpretation of what he's doing, which is quite narrow. When Piketty is talking about capital, he's really talking about the value of all marketable assets, real estate, land, stocks, bonds, and so on. And one needs to be careful to distinguish this from the sort of K in neoclassical production functions, the aggregate production function capital, and this debate.
Which you don't think he does? Again, pardon me for interrupting.
I think that he does, but when he talks about the substitutability of labor and capital, he uses this.
Yes.
He uses this aggregate production function framework, but the data that he's putting on the table, includes such things as the public debt, as part of capital, bond holdings, land holdings, and so on and so forth, things that encompass, but certainly are not limited to capital in the process of production, and so the criticisms are, in a sense, they are. He needs to address them because he uses this framework in the book, actually, when he talks about substitutability between labor and capital. And I don't believe these have been adequately addressed. But I also think that they adopt too narrow a view of capital relative to the classical economists and relative to even Piketty's empirical work. So all this has to be sorted out. But I just think that I think that this will be sorted out. I mean, it'll be adjudicated in some way. But unlike the FT critique, it's there hasn't been a response from Piketty, as far as I know, so far.
Well, let me ask you this. So we're both economists. We were both trained in neoclassical growth theory, and the general view that economists bring to trying to understand what the relationship should be between some of these key variables that Piketty is measuring and discussing in his book. That is to say, between the size of the capital stock in the economy, the rate of return on capital, the share of total national income that goes to people who own assets, the growth rate of the economy, the growth rate of the population. There is a fairly well-developed, more or less consensus view amongst economists about how to think about that.
Yes.
And Piketty eschews the conventional practice in the economics literature of making explicit a formalized model of these interrelationships into which he could then fit his empirical observations.
Yes.
Rather, he kind of moves along with a few identities and a few basic relationships, which one is never clear are to be understood as causal or simply definitional, and then heavily leans on his empirical observations and common sense to get from his, what did you call it, from his description to his interpretation. So I think some of the disaffection in the economics community is that he hasn't played by the right rules of the game here by making explicit and concrete exactly what the structure is that he imagines the economy to be functioning in. Would you agree with that?
I agree with that. I on the whole, I think that he does have a model in mind, but it's a very different kind of model. It's so there's a recent paper by Piketty and Says in Science, just recently published, where they describe the model, and it's really very different from the kind of model of sort of an intertemporally optimizing representative agent or even a distribution of agents that you would normally find in the growth literature, which sort of goes back to the Ramsey growth model. And he doesn't. This is one of the subplots that I'd like to talk about if we have time. He doesn't really believe that savings decisions are done for life cycle or precautionary reasons. That wealth doesn't accumulate in order to be spent down in our in the latter years of one's life. And so he prefers a sort of what I think it would be fair to call a fairly mechanical model, where there are both multiplicative and additive shocks to wealth. And he has laid this out in previous work and in this recent Science paper with Emmanuel Says. And there you get a steady state distribution of income, a steady state distribution of wealth, And the degree of inequality in that wealth distribution does indeed depend on this difference between R and G, as he claims. So he has a model in mind, but it's a very different model from the ones that that are familiar from the growth literature. That's absolutely
again. In the interest of making clear to those who might be listening who are not experts in the field, the reason this business about savings is important, and I do want you to get into that particular subplot in more detail momentarily,
yes,
is that the return on capital can be spent as well as saved and passed on across generations, and to the extent that it's consumed, that cuts against the trend or the tendency toward the inequality in the holdings of capital to get ever greater. So
yes.
the underlying view that one has about what motivates the acquisition of the assets in the first place will be connected to how it is one imagines those assets will be consumed or spent, either consumed or spent or not over time. And that then factors into the conclusions that one draws or the prediction that one makes about the long-term wealth inequality trend.
Yes, yes, that's right. I mean, some of the criticisms that I've heard, including the one that you had on your conversation on Blogging Heads with Larry Kotlikoff, are really quite absurd if one has read the book carefully, because he's absolutely aware that people with large fortunes spend large amounts of money on personal consumption. He's aware that people squander it sometimes, that they gamble it away, that they make big losses, that they donate it to charity. I mean, all of these things he's aware of. But he prefers to capture it through these multiplicative and additive shocks. That wealth can be subject to both negative and positive shocks. Some people get high returns, some people get low returns, some squander their wealth, and some accumulate it very effectively. The thing that he seems not to believe, which is a very important point actually, he seems not to believe that intertemporal optimization motivated by the consumption, one's own private consumption over the course of one's lifetime, or the private consumption of one's children or their children, that this approach to savings does not adequately describe human behavior at the top of the wealth distribution, that the accumulation of fortunes as an end in itself is an important driver of wealth accumulation. This I think is fundamental. He describes it in very stark terms. He just says that, he says Modigliani's life cycle theory, which is perfectly plausible a priori, just doesn't fit the empirical facts. So he has a different theory of saving.
It would seem. I'm sorry. I just want to observe that the rising significance of very large fortunes and the increasing concentration of wealth, not only in the top 1%, but the top 1% of the top 1%, makes this point extremely important.
Yes.
Because whereas one might think that for the vast majority of persons who are saving, the motivations for savings are precisely this: you earn more in your youth and you try to hold on to assets that will allow you to live in your retirement.
Yes.
That is undoubtedly true as a common sense and as a more closely observed empirical description of the behavior of most people. It may not have much to do with the dynamics of capital, to the extent that capital is in the hands of people who couldn't possibly imagine themselves consuming the totality of their fortunes within their own lifetimes, and plausibly are not so connected to or concerned in their imaginations about the wealth that they will hand off to 2 or 3 generations removed, that you could take that to be a motivation for the way in which they behave.
Yes, I think that's right. That at the top of the wealth distribution, the motives for accumulation don't fit the life cycle model very well. But he doesn't actually believe that those motives really apply anywhere in the wealth distribution. And there's a very, very interesting book, a wonderful book by Mia and Sufi called House of Debt that I read immediately after finishing Piketty. I've been meaning to read it.
I've heard about it.
It's outstanding, and it's much shorter, much easier, much quicker to read, and also very accessible to the layperson, designed to be accessible. And they actually make the point, and it's a very complimentary point to Piketty. Is that at the low end of the wealth distribution, you also have decisions that are made with regard to over-borrowing, with regard to extracting home equity and consuming it. At least that the financial crisis in the United States and elsewhere in the world was driven in large part by people borrowing against home equity. and to a level that can't be reconciled with our standard intertemporal optimization models either. So there's this interesting complementarity where you have what you might consider to be oversaving relative to the benchmark Modigliani model at the top, and undersaving or overborrowing relative to the Modigliani model at the bottom. So I think these are the most interesting things to take from this work, this very, very careful empirical work. Mia and Sufi have also got a wealth of empirical data that they sift through, just like Piketty. And the two books together suggest that we really, really do need to rethink savings in our models. And I mean, unlike Piketty, I think that we ought to be doing more theory, building better mathematical models. But these need to take into account the proper motives. I think that we have been in a straitjacket to some extent by forcing ourselves to think in terms of intertemporal optimization with regard to lifetime incomes, and really.
Okay.
Yeah.
Well, I want to get you to talk a little bit about some of the other subplots that you think are significant and that have not garnered as much attention as they deserve that are in this book. So what's something else?
Well, we've been talking about private saving. Another important thing that he discusses is national saving. And, this is a central question in development. How much do you rely on foreign capital to move out of poverty if you're a developing economy? And he makes the claim that really the late industrializers were effective because they, not because they were autarkic. They used open borders and favorable terms of trade to reach the global technological frontier through the diffusion of knowledge and so on. So the number of factors related to openness and participation in the world economy that were crucial to the development of countries such as South Korea and Japan and Taiwan and more recently China. But they were able to mobilize domestic savings to a much larger degree than some other developing countries. And his big concern is with Africa. So he argues, and this is something that I had not seen before anywhere. He argues that you have countries that have run deficits for a number of years, and they end up with a lot of their domestic capital owned by foreign residents, and other countries like Japan and Germany that run trade surpluses for a number of years, and they end up with positive net asset positions. They own capital in other countries. But what Piketty points out is at the level of continent blocks. So if you look at Europe, or you look at Asia, or you look at the Americas, there's rough balance. There's the deficit, the countries with sort of negative net asset positions, whose capital is owned by foreigners, and those with positive net asset positions, those who own capital in other countries, they really net out to something close to zero. With the exception of Africa. Africa as a continent is foreign owned to a degree that you haven't seen elsewhere at the continental level beyond the colonial period. In the colonial period, of course, a lot of Africa and Asia were owned by the European powers. A lot of their capital was owned by the European powers. And he suggests that there may be two problems with this. Firstly, the outflows of capital income from Africa are substantial and ongoing and don't show any signs of diminishing. And they far exceed inflows, for example, of foreign aid. And this can give rise to a couple of different problems. And one of these is a cycle of what he calls expropriation and protection of property rights. So you get you'll get coups or revolutions that expropriate foreign capital, and in the name of national development, they are not terribly successful in achieving national development, and then they're replaced by governments that will be more protective of property rights, including the property rights of foreign residents, and that this sort of political instability can be a consequence of large foreign ownership of domestic capital. Now, this is something that seems worth exploring empirically and thinking about a bit more deeply theoretically. But the fact that a developing country depends on diffusion of knowledge, and diffusion of knowledge can come sometimes through foreign direct investment, and that leads to foreign ownership of domestic capital. but whether or not there's a cost to that, whether or not one really needs to mobilize domestic savings and have less foreign ownership is a critical component of development. It's an important question.
Okay, let me. I want to interrupt for a minute because I want to make sure I understand the point, as well as hopefully being able to make it comprehensible to others.
Yes.
So now what we're talking about for developing countries is the fraction of their capital stock owned by people who are not nationals, by foreigners.
That's correct.
We're observing empirically that while there is some variation across countries in this measure of outside ownership of capital, for most large geographic areas, call them continent blocks, North America, Asia, Europe, or East Asia, I'm not sure, there is a net balance in the sense that while each of countries in these regions may own significant assets in other countries, the capital stocks of these countries taken collectively tend to be owned pretty much entirely by the populations of these countries taken collectively. So now that's an empirical observation.
That's not quite. That's not quite what the claim is. It's that their net asset position at the continent level is in balance. So what the countries in a continent, let's say Europe, collectively own in non-European nations is roughly balanced by what non-European nations roughly own in Europe. So it's not as if Europeans own European capital. It's that European ownership of non-European capital is roughly balanced by non-European ownership of European capital.
Okay, now why is that measure, the relative amount of capital owned outside of the geographic bloc by people inside of it, as compared to capital inside the geographic bloc owned by people outside of it? Why is that significant? You mentioned one possible link, which is if outsiders own capital, then insiders may want to take it away from them, and that makes for institutions that are not consistent with promoting economic growth, confiscatory institutions,
yes,
instability, and so on. So that's one thing. But as an economic matter, why would the net asset position of a country or a group of countries be significant for that country's development?
Aside from the potential political instabilities that he mentioned,
well, that's the main factor then.
Not necessarily. So he also explores the possibility that that the capital in most of the world may end up being owned, for instance, by the Gulf states or the Norwegian sovereign wealth fund or the Chinese sovereign wealth. It's these are.
Would that be a bad thing?
May not be, but one needs to take this argument about the possibility that the positives that come out of the free flow of capital across nations may have some negatives associated with them too, and I just think it's worth thinking about. I don't really see a mechanism why continent blocks should be roughly in balance with net asset positions. Is it just a coincidence, or is there some deeper meaning to this? I really don't know, but it's worth some thought.
And is the exceptional status of Africa in this calculus as being disproportionately in deficit on this kind of accounting?
Yes.
Is that a legacy of colonialism? Is that people built structures and created factories and other kinds of capital assets in the process of the colonizing, and that the claims on those assets remained in the hands of outsiders even after those countries became independent nations? Or is there some other account of why Africa is an outlier in this respect?
Well, colonialism affected a number of countries outside of Africa. It may be part of the story, but it's not the whole story. It has to do with development strategies and the degree to which domestic savings have been mobilized for investments in human and physical capital domestically. And the colonial legacy in combination with a particular development strategy, normally you do not want to restrain domestic consumption in a country that's already poor. That's going to cause a great deal of pain. And yet sort of sustainable development seems to require it. At least the examples of the East Asian companies seem to suggest that's the case. So there's a dilemma there, but it's part colonial legacy and part development strategy. But an interesting fact is that Piketty notes in his book is that Canada in 1910 was roughly in the position that Africa is in today in terms of the foreign ownership of its domestic capital. And that has changed very, very dramatically. So Canada is much closer to being in balance now. And of course is a developed country, is far more affluent than it was in 1910 and far more affluent than the countries of Africa today. But then you have this very unusual period, this aberration, as you put it, the wars and the depression, which caused the European powers in particular to disinvest, to sell off some of their capital holdings. They had the destruction of their own capital in order to finance their war expenditures, and that led, or that was part of the process that led to Canada having a net asset position that was closer to being in balance. There doesn't seem to be anything on the horizon that will cause the African nations to have a balanced net asset position anytime soon, which means that a lot of the revenues that are generated in these countries is going to flow out in the form of capital income, and it seems plausible, at least, that could be a source for political instability.
I see. Any other subplots you think worth mentioning?
Well, I think that it's, one of the interesting things. So it's a very sort of, the scope of the book is very grand. This is the unfortunate thing about the reviews. So, he's very interested in ideas, and ideas towards the public debt, ideas towards taxation. And he talks about the fact that, around the second decade of the 19th century, when David Ricardo, the great economist, was writing, Britain's national debt was twice its national income. So it had an enormous debt, and it paid. It paid for that debt. It didn't repudiate that debt, and it didn't inflate away its value. It paid for it with a century of government surpluses, in part assisted by its colonial holdings. But attitudes towards the public debt in the 19th century, according to Piketty, were very different from what we find today. That it was viewed, and I'm quoting him here, as a tool of private capital. That people at the top of the wealth distribution benefited from government debt because it was a safe, reliable, generous source of returns that would eventually be paid for by taxes on a broader subset of the population. So the public debt was viewed as being redistributed, but redistributed in favor of the affluent in the 19th century. And then attitudes towards the debt changed a lot through repudiation and through inflation in the 20th century. And the public debt is now viewed as something that is more benign, at least from the perspective of the less fortunate in society, that the public debt helps us to finance either transfers or public goods that benefit folks with low wealth or low income. And he thinks that this is I'm using his words here, a dangerous illusion, actually, because we're in a low inflation environment right now. And so these ideas tend to persist, even when they're no longer applicable.
I'm sorry, what is the illusion in this example?
Well, the illusion is that the redistributive effects of the public debt are favorable to those at the low end of the wealth distribution, and that was the case when the bondholders had the value of the debt eroded through inflation or through outright default. But we're not in that kind of environment anymore. So he doesn't believe that public debt is beneficial to those at the lower end of the wealth distribution anymore.
Okay, again, let me try to explain this for people who are not economists. And again, please do correct anything I say that's not right. So here we have the state, the government of Britain or France or the U.S.
Yes.
Going out into the borrowing market and issuing debt, claims on future taxes if they're to be paid, the debt is to be paid in order to finance a war or to finance public consumption of some kind or another. The benefits from the consumption are broadly shared, but the obligations to repay the debt may or may not be broadly shared.
Right.
To the extent that the debt is held by wealthy people who are using public bonds as another vehicle to store their wealth, and to the extent that the government, in quote, repaying the debt, does so in dollars that are less valuable than the dollars that were issued when the debt was initially issued, that the dollars that were collected when the debt was initially issued. That is, they allow the economy to inflate through an expansionary monetary policy so that the nominal repayment of the debt is actually less in real value. To that extent, the whole process will have benefited those who got the benefits of the public consumption that was financed by the debt.
Yes.
And that's the broad public. On the other hand, to the extent that the debt is taken seriously, that the environment is low inflation, either because of policy or for other reasons, and it's really going to be repaid dollar for dollar, what we have here is a pretty good return on the wealth of the people who are the owners of the claims against the government. Yeah. Those are the wealthy, and not so much of a redistributive effect of this whole public financing process.
Yes, in fact, that's exactly right. That was well described. That it's what's really interesting, from a history of thought point of view, but also from the point of view of the way in which we think about theory. So when Ricardo was writing in his Principles of Political Economy and Taxation and his other tracts in the second decade of the 19th century, he observed that this massive increase in public debt had come without crowding out private saving. He didn't use the word crowding out, but actually private saving rose to accommodate the increase in the public debt without lowering private investment. So the growth of the private economy wasn't hurt. And he formulated what has come to be called Ricardian equivalence. And really, Piketty's interpretation of what happened at that time was that, people with wealth found in the public debt one very attractive channel for high returns, secure, reliable, generous, because there was very little inflation throughout the 19th century, and in the UK, in Britain. And so it was really, in a sense, a benefit or a gift to those who had the means to purchase the bonds. And so the way we think of Ricardian equivalence is completely different. We think of Ricardian equivalence, following Barrow and his work, as private savings increase because because future taxes are anticipated, and one accumulates wealth now in order to pay the future taxes that will be used to settle the government debt. And Piketty doesn't believe that this is why the public debt did not crowd out private savings in the 19th century. It's quite the opposite. So,
this point is really important, Rajiv. I think again it needs to be just dwelled on for a moment.
Okay.
So what we're talking about here is the extent to which it's possible to increase aggregate spending through the government's borrowing and spending, and whether or not private individuals will offset the greater public consumption by reducing their own consumption or increasing their savings.
Right.
This is, to the extent that this happens, we have a kind of Ricardian equivalence. Yes. That is to say, a kind of neutrality in the aggregate effects on consumption of the government's financial position.
Yes.
Now, one account of that is that when government bonds are introduced, it's an innovation in the financial technology of generating assets for people who own wealth.
Yes.
And savings might have gone up and consumption not gone up in proportion to the government's borrowing, precisely because wealth holders now have a better way of storing their wealth,
right,
and so are more likely to want to store it than to consume it.
That's right.
And that's where the offsetting comes from.
That's exactly right.
That's what Ricardo was saying in the 19th century. In the 20th century, Robert Barrow and Chicago, Minnesota freshwater macroeconomists are saying, you can try to fight a recession by going into heavy government debt and spending, but you know what? You won't actually generate more aggregate public consumption, more aggregate consumption overall, because people will know that eventually those bills are going to have to be paid that the government has incurred, and they will internalize that and reduce their spending accordingly in anticipation of having to pay future taxes.
Yes.
That is not at all. Piketty is observing that that's not what Ricardo was saying in the 19th century, and it has enormous implications for what you imagine to be the effectiveness of government policy in response to recessions in the 21st century.
Yes, yes, that's right. Not only the effectiveness in terms of aggregate demand and employment and so on, but also in terms of distribution. So Piketty's claim is that was a distributive shift in favor of people at the higher end of the wealth distribution who could invest in these bonds, and there was a new opportunity for them. So that's a very different interpretation of Ricardian equivalence, and I wonder if the term itself is somewhat misplaced now because the intertemporal optimization, we talked about this in the context of savings earlier, but it's exactly the same argument that underlies the Barrow's argument on Ricardian equivalence. It's an intertemporal adjustment of consumption plans in light of the fact that higher future taxes are anticipated. And
it's got to be not just intertemporal within a personal life. It's got to be intergenerational, given the time spans over which these things are playing out.
But this is exactly Barrow's contribution, right? He constructed a model in which people care about their descendants, and the descendants care about their descendants, and so on, and in a sort of a representative agent dynastic model, in which these effects arise. But Piketty's claim is that the original data that motivated Ricardo to offer a hypothesis along these lines can't really be understood in these terms, and that the distributional effects of the wartime expenditures, these can't be understood in the representative agent model. In fact, that's in discussing Ricardian equivalence specifically. That's when Piketty is most critical of representative agent models, actually, because representative agent models will miss these kinds of distributional questions.
Okay, I want to get your reaction to something that's a little bit different, still about the book. Okay. I want us to talk for a minute about the book, if you will, as a piece of economics writing, as if you like, a piece of literature.
Yeah.
Because it did hit the charts. It's top of the Amazon list. It was almost impossible to get one's hands on the book for a period there. I don't know how many hundreds of thousands of copies it will have sold already, but I'm sure that Thomas Piketty is going to become a wealthy man as a consequence of this book.
Yes.
He may choose to donate the proceeds to charity, or he may not, and I don't think it's any of my business what he does with his money. But it's different from what you expect to be produced by a modern economist. The book is ambitious. He fancies himself in conversation with David Ricardo or with Thomas Malthus or Karl Marx or John Maynard Keynes in some sense. I mean, the style of it is quite grand, and the sweep, there's something audacious about it.
Yeah.
So what do you make of that? Is that a harbinger of things to come? Is that long overdue? Is that pretension? People say he quotes Balzac and, I don't know.
Jane Austen.
Jane Austen, yes, indeed. I wasn't so much moved by the fact that he was quoting novels. Yeah. I mean, so what? But,
let me speak to that point, because in your conversation with Larry Kotlikoff, he felt that you had been seduced by the fact that he was quoting these novelists.
He did, and I took umbrage at that suggestion.
yeah, that's right. But there's a reason why he's doing that, and he describes it. He explains very, very clearly why he's drawing upon the works of Austen and Balzac and others. And that is because they describe inequality, with an evocative power that you just cannot get with statistics. And really, they are discussing social standing and social status and what it takes to maintain certain kinds of social status. And, I grew up from the age of 11 in the UK, but prior to that, I was in India. And you see even today, the importance of social standing and social status quite independent of wealth. In all kinds of different ways, and these kind of societies were described by these 18th and 19th century authors in great detail. And this actually relates to another interesting point. Piketty thinks that certain types of statistical measures, like the Gini coefficient, which he calls abstract and sterile, they give you a picture of inequality, they give you a number, and you can track that over time. But what they miss completely is where one stands, in one society. You cannot really give people a sense of where they stand relative to others, and whether or not that standing is durable in some way. And so he prefers what he calls distribution tables. And the distribution tables are simply, a look at the top decile, or those who are below the median. What share of wealth do they command? What share of total income do they receive? And he compares these to the social tables, what were called social tables back in the 17th, 18th, and 19th century, where people would write down, the list, a list of noblemen and artisans and farmers and what wealth they owned, and so on and so forth. And this paints a very rich portrait of society, which you just simply cannot get from statistical work. So he's not quoting Balzac and Austen in order to seduce the reader into thinking that he's a great social scientist. He's doing it because he's interested in the texture of inequality in a deeper sense than simply the quantity that person A owns relative to person B. And to me, if I were to describe the main message of this book, it would be this: that there was a dramatic structural transformation in European society from 1910 to about 1970, where a property holding middle class emerged. In 1910, basically 90% of European wealth was held by the top decile. Half of it was held by the top centile, and basically the 40% immediately below them and the 50% at the bottom were not terribly distinguishable in their levels of ownership. But what happened since then is that this middle group, the 40% below the top decile but above the median, ended up increasing their holdings of wealth sevenfold in relative terms. So they went from holding 5% of aggregate wealth to 35%. This is one of the most striking tables in the book. And this emergence, what he calls the emergence of a patrimonial middle class, was a historical innovation of great magnitude, and it has a lot of implications about the stability of the system. So he speaks at times about what he calls the apparatus of justification. Whenever you have inequalities, they are tolerable to people as long as they're felt to be justified. And the emergence of this propertied middle class is a key part of explaining the stability of the system, the sustainability of inequality.
So, and if I were, here's. I'm sorry to interrupt you, Rajiv.
That's fine.
I was just going to make this point. There's political economy going on here.
Yes.
I mean, I think back to the observation about external ownership of a country's productive assets and the extent to which that induces a tendency toward expropriation, revolution and expropriation, which has negative implications over the longer term for the kind of development, the evolution of institutions within the country, which would promote solid and sustainable growth. Yeah. And now we're talking about the role that the distribution of wealth, of income and of wealth plays in the political stability of the society. Yes. And the importance of there being a prosperous middle class. Now, if the 40% of the population who are situated above the median but below the top 10% are owning 35% of the country's assets, that's a solid stake in the structure of economic relations.
It is.
By a stable, prosperous, not quite a majority, but a very solid plurality of the population.
Yes.
That is a really good thing for political stability, which is a really good thing over the long term for economic prosperity.
Yes.
But it's something that I gather he thinks is in danger of being lost if the tendencies that he's identified are actually to play themselves out.
That's right. So he calls it a fragile historical innovation. And if that were to be reversed, if that transformation were to be reversed, I think that with good reason, I think there would be significant social turmoil, or at least there's reason to suspect that there would be. But this you mentioned the scope of the book. These are the kinds of issues he's grappling with, and I don't think that the reference to literary figures and the individuals, people standing in society and so on and so forth, are gratuitous or that they're designed to seduce the reader. I think they play a part. They play a part in telling the story. Like I said, he's interested in the texture of inequality, not just in the magnitude.
This texture of inequality point I think is really nice. I recall my reading of Charles Tilly's book, Durable Inequality, which starts off with an anecdote. It's not quite an anecdote. It's a little historical factoid. Mm-hmm. It has to do with analysis of the enlistment records of the British Royal Navy in the late 18th century. And what Tilly observes is that they had measures of the height of people by their rank.
Yes.
So the enlisted personnel, the people who were working at a very low level within the hierarchy of the Royal Navy, tended to be working class people. And if I get the number wrong, it'll be off by an inch or two, but their average height was something like 4 feet 8 inches or something like that.
Yes.
Okay. This is 1778, whatever.
Yes.
And the officer corps, who tended to come from the upper classes, were over 5 feet 6.
Yes. Yes.
And he then goes on to invite the reader to consider how a word like haughty or a phrase like looking down your nose at might have come to reside within the English language.
Yes, yes, yes.
And there was a physical manifestation of the inequality and then a linguistic reflection of the inequality. And the scene is so vividly painted, but it was a brilliant move, in my view, literary.
Yes, yeah.
Because all he did was go to the historical record and cite some historian's compilation of the height data, and then he went on for another 25 pages to tell us about the texture of inequality.
Yes, that's right. That's exactly right. And to me, this is these are the most interesting things to think about coming out of this debate. And you and I are both we share long-standing interest in group inequality, in identity-based inequality, and really high levels of wealth inequality or income inequality, if they did not go hand in hand with large differences in status inequality or on the degree to which one group considered themselves somehow inherently superior to another, they would be far less corrosive to a democracy, which is based on the idea that we are created equal and endowed with certain inalienable rights. This is a creed to which we pay lip service to in the United States, and we are obviously coming out of a history where for a big part of the population those were just words, but the ideals have value, and if to me the thing about increasing global wealth inequality, the concern that I would have would be not so much the inequality in material resources in itself, but rather whether or not it sort of ossified into a return of social hierarchy and social status, which it seems to me that at least in the West we have been moving away from over the last century.
Well, I take note of 2 books, both by Harvard political philosophers, or at least formerly Harvard. Michael Walzer's Spheres of Justice, and Michael Sandel's, I think it's called What Money Can't Buy, or something like that. You know these books?
Well, Sandel's, I haven't read Sandel's book. I mean, I did attend a lecture of his in Toronto recently at the INET conference, so I'm familiar with some of his arguments.
Just to make it quick, Walzer argues in this book of 30 years ago that when he says spheres of justice, he says, commodities are not all the same. Money is, stuff is not entirely fungible, so like health, you either got it or you don't, and it's kind of hard to substitute money for health. I mean, you could do that a little bit at the margin, but, you can't. Political power, monetary, that's the prestige, recognition, money, these are kind of different kind of commodities. And the norms that should govern inequality in these different spheres will in general be different.
Yes.
The idea that no one should die from cancer because they can't afford treatment is one thing. The idea that someone who has a good idea and ends up making $1 million because they write a book like Capital in the 21st Century is quite another. I might well not mind the inequality that comes about from people writing best-selling books, but I would mind greatly the inequality that comes about from people buying elections or being. So it's contamination. It's having a lot in one sphere, contaminating the norm that governs how the other spheres' resource should be distributed. So that's kind of one thing that I think is touched on here.
Yeah.
Sandel is worried that that kind of corruption is ongoing. I mean, he gives us examples, and some of them may seem trivial. If you want to hear an argument at the U.S. Supreme Court and you're a big-time Washington lawyer, because the seats are allocated on the first-come, first-served basis, people will pay low-wage individuals to stand in line, sometimes over 24 or 48 hours, securing a place for them, and then they'll walk up 10 minutes before the court opens for argument, take their place in line, and go in and sit down while others have to do standing room in the back. And he's saying, Sandel, is that we ought to be thinking very hard about how we're allowing more and more the sphere of great wealth, which is unequally held, to induce other kinds of inequality. You know, standing in line while somebody is walking past me and going up and getting in a nice seat in the Supreme Court would really kind of piss me off, you know.
Yeah. Well, you know, I mean, relatedly, the you know, one dimension of inequality that I think isn't taken seriously enough, really, except in certain contexts, is the inequality in human dignity. And it's really, you know, I think that, you know, inequality in dignity is more corrosive to a democracy than inequality in income or wealth. But I think that, you know, one of the concerns that comes out of this book, and I wonder to what extent Piketty himself would agree with this, is that there's a limit to the amount of inequality in wealth that one can have before one starts getting inequality in dignity, as a necessary consequence. And really, I think of a society in which people may have roughly equal distribution of wealth, but where one group is viewed as subordinate to another, you know, as lacking in merit along some dimension, as being in some ways a more unequal society than one where people have rough equality of dignity, but large inequalities of wealth. So I don't know. I'm rambling a bit here, but I think that these things matter, and you know, it's a credit to Piketty that, you know, he's able to cause people, readers of the book, to go off on these kind of tangents, because it's a very provocative, interesting argument that he's making.
Yeah, I think we've reached a natural stopping point. I agree that the book is very profound and provocative, and I think it's going to have a long life in terms of influencing discourse in our discipline and outside of it. So thanks for coming on to discuss it with me, Rajiv.
Oh, thanks for inviting me on, Glenn. It was a pleasure.
Okay. It won't be our last conversation, I'm sure. Take care.
I'm sure it won't. Okay.
Bye.
Bye-bye. Bye-bye, Glenn.